Welcome to Financial Statement Analysis. Over the next 4 video sessions, I'm going to attempt to expand your knowledge regarding financial statement analysis and the major tool in which we use to perform this, which is ratios. Financial statement analysis is a useful tool for both external and internal users as they make decisions about their company or another company. Management uses financial statements to assess the adequacy of cash flow to pay for operating expenses. In other words, do I have enough money to pay my bills? Can I pay my utilities, my rent, my employees? Secondly, they also can look at the efficient use of company resources. Is my cash just sitting there doing nothing? Should I be investing it in equipment? Should I be investing it in people? Is my equipment generating the sales that I want it to be? Am I getting the return that I need to make my shareholders happy? And lastly, my overall performance of my company. Am I profitable? Am I getting the growth and the return that I need? All of this can come out of financial statement analysis. The most compelling reason to analyze financial statements is simply that it provides useful information to supplement information directly provided in the financial statements. However, there are a few limitations that decision makers must also be cautious of when using financial analysis. First, financial statements are prepared using generally accepted accounting principles, or better known as GAAP. However, GAAP allows financial statement preparers to use a variety of methods, estimates, assumptions in their preparation. To properly prepare and interpret financial statement ratios, these methods, estimates, and assumptions must be considered. Second, decision makers using financial statements and the resulting ratios should not place too much emphasis on any single ratio. Ratios must be looked at as a story that cannot be told with all of the pieces. Third, financial statements are prepared using historical cost and therefore are not adjusted for the effects of increasing prices. Therefore, financial statement users must consider that the impact of changing prices could be dramatic and not necessarily reflected in these financial statements that we're looking at. There'll be 3 tools that we'll be looking at here in this first session, 2 of which should be a review to you, and 1 possibly could be new. So the first one that we're going to take a look at is horizontal analysis. And I hope you all remember that the idea between horizontal analysis is to analyze the changes that occur between the years, the previous year and the current year of the company and their financial statements. To facilitate this analysis, we take dollar and percent changes, and they're calculated on each item. We're going to use Robin's Boutique as an example throughout all 4 of the video sessions. Robin's Boutique is a retail store specializing in children's clothing, and this is how they might use horizontal analysis. Here is Robin Boutique's balance sheet, and they have performed a horizontal analysis. Let's remind ourselves of what horizontal analysis means and what the formula looks like. So to get the increase or decrease, which is the dollar amount change from year to year, we take the current year minus the previous year, and that equals that. To get the percentage, we then divide this by the previous year. And you can see here that that is what Robin's Boutique has done. Please note that when you see brackets, that means a negative number or perhaps a decline from year to year. As they're showing us here, exactly what I just illustrated, current year minus the previous year, they use the term base year, divided by the base year, and that's how they got that particular percentage. If we move forward, we can see on the income statement here that although sales have increased, expenses appear to be rising much faster than what the sales are. And the percentage changes in cost of goods sold and total expenses show that. And so although sales increased, which we saw here, even though they have in fact increased, expenses are also rising. And so they're not necessarily charging what they need to help cover their expenses. So even though they're making more sales, their expenses are also rising, which is causing them to have a less income. So we might want to take a look at that as a management team to see how we could get the expenses more in line with our sales increase, maybe by increasing volumes, doing a different supplier, and so forth. So this information can be very valuable to managers. So some additional attributes here of horizontal analysis include that most of the time you will find at a minimum at least 2 years of financial data for a company, at least 2 years of financial data. Many annual reports, remember that's the 10K for corporations trading publicly, include up to 10 years of financial information. Using these supplemental reports, readers of financial statements can perform what we call trend analysis. Trend analysis can be used to identify problems of abnormal account changes. So that means you can take your 2, 5, or 10 years of data and graph them and see where the peaks and valleys are. And then in that, you can go back and see what the peaks or the valleys, depending on what you're wanting to look at, and what attributed to those. And therefore, management can take a look at what was good or what was bad and what changes they might need to affect in their particular business model, helping to correct these peaks and valleys or be able to explain them when users of the financial statements want to know. You will have an opportunity to do some trend analysis here in your project this semester. Here we're looking at what we call the statement of cash flows. This is the fourth statement in the financial statements. And what we're doing here is the same thing. It just looks a little bit different. But you can also do horizontal analysis using your statement of cash flows, not just your balance sheet or your income statement. It is done the same way, current year minus previous year divided by previous year. Now let's go ahead and take a look at the second one, which should also be a review for you in looking at vertical analysis. Vertical analysis compares financial statements of different companies and financial statements of the same company across time after controlling for their differences in size. When comparing companies of different sizes, it's useful to standardize the statements, and this is how we do that. We do what we call common sizing. Common sizing is taking all items and we restate them as a percentage of a selected item on the statements, which means we're going to remove size as relevant variable in ratio analysis. We use common sizing statements or vertical analysis to compare companies that make similar products. We also can compare our same company across years. And I'm going to go ahead and remind you what this means on how we're restating. So for the balance sheet, we restate by taking the account balance divided by total assets. On the income statement, we take the account balance and we divide it by sales, also called net sales. Now let's take a look at how Robin's Boutique might have handled vertical analysis. So here is Robin's balance sheet, and you can tell that we have, as I had mentioned, we're going to take the account balance, which is $130, divided by the total assets, which is $930,000, which you can see here. That comes up with our 14%. And you do that for this one, this one, this one, and so on. And at the end, the total assets should total $100,000. When you come down to liabilities and stockholders' equity, you're going to do the same thing. It'll be $10,000 over $930, $10,000 over $930, $80,000 over $930 to come up with these particular percentages. What this does is now I can compare my company versus itself, and we can look at the changes in the accounts, how they either go up or down, or how the percentage of assets have changed. Or we can go ahead and also take a look at another company, and by taking out the size and just doing a relationship, we can see if the other company, let's say they were 14.9, we are in line at 14%. If another company might have this higher or lower, we might want to look like in the same industry why we don't match up. And so that's the beauty of being able to use vertical analysis. The next one we're going to take a look at is working capital. Working capital is defined as the excess of current assets over current liabilities. And it's a measure of an entity's liquidity or the ability to meet its immediate financial obligations. Let's notice here that Robin's working capital has increased by $22,000. 430 over minus 408 gives us the $22,000 from the prior year. Without knowing more information concerning the makeup of working capital, the information is of limited use to us. If current assets consist primarily of inventory, think about it, the company's liquidity could still be in jeopardy, right? Because what do we have to do? We have to sell the inventory. Sometimes they buy it on credit, so then we have to take the accounts receivable and turn that into cash. So that could take some time and slow down our actual conversion to cash. So we want to make sure that we want to take a look at basically what is in our current assets and really what is liquid. Again, working capital is simply current assets minus current liabilities equals working capital. So we're going to leave working capital and go to vertical analysis for the income statement. So here it's exactly the same way that we did it using the balance sheet, except for what we want to do is just note that our account balance is going to be this over sales. So each of them will be over sales. So it would be 500,000 divided by sales revenue. And that is the difference between the balance sheet, which uses total assets. So noted here, all expense and other income accounts are stated as a percentage of sales revenue.